Welcome to another session on I Have Questions. If you haven't subscribed, please do, and remember to click the notification button so you will know when new content is published and you won't miss out on any of our great series. This is the third video in the 10-point series You and Your Bank Account. In the last video in this series, we examined some limitations on the capacity of statutory bodies, corporations, and individuals to make banking contracts or to interfere with the banking relationships of others. Today, we will address the question, who owns the money in an account? It's a funny one, but legally, it translates into whether the bank is your trustee, your bailee, your agent, or your debtor. Well, do stick around and find out which it is. We will also look at the roles and remedies available to you and your bank under your banking contract. We have included timestamps in the description and we will provide references at the end of the video just so that the video is easier to follow no matter your background. Seriously guys, with your help, we are learning how to keep the legal jargons to a minimum without losing the sense of the videos. So let's see how it goes here. Okay, who owns the money in an account? Let's not be quick to say it's for the customer. Banking contracts can create variant relationships that tussle between ownership and possession of money, among other things. And these variant relationships could come either in the form of an agency, a bailment, a trust, or a debt. Please don't get bored. These will help you know how to approach your banking contract. For a moment, let's see how these relationships work. Okay, agency situations exist where a person called an agent is authorized to act for or in place of another. That's the principal. Sometimes an agent may be required to enter into, take possession of, or deal with the principal's property, but the principal will always have ownership. Among other duties, the agent owes the principal specific fiduciary duties to act within authorization, to render accounts on all dealings, to disclose material facts within his knowledge, not to make secret profit on the principal's property in his lawful possession, and to avoid conflict of interest. These duties make it difficult to categorize the bank as your agent, since to owe these duties to customers in millions will be onerous for a bank to perform and will most likely cripple the essence of banking. Okay, bailment situations arise where a person called the bailee holds custody of property for another only to return it at a later date. This usually applies to physical property. We call that chattels, property that the bailee lawfully takes possession of. Then again here, a bank is not a bailee for the deposit it receives, since money is not placed with the bank as chattels, but as value in abstract. And we'll soon see why this is so. Next is trust. Please, when we say trust, we don't mean confidence. We are referring to the institution of a trust whereby someone called the trustee is compelled in equity to own, hold, or deal with property for the benefit of another person, that's the beneficiary, in such a way that the real benefit of the property never goes to the trustee. Typically, a trust splits ownership of the property between the trustee, who has the legal ownership along with the management and control of the property, and the beneficiary, who has an equitable ownership of all benefits accruing from the property. The trustee must, as of necessity, act in the sole interest of the beneficiary only. To classify banking relationships under a trust will downplay the role of banks for profit-making and financial intermediation. Besides, this will cascade into a chaotic conflict of customer interest, since each customer would claim that the bank must act in its sole interest to the detriment of the next customer. With this, banking can't be a trust. So this leaves us with debt situations. A debt simply arises where you give out property and expect it to be returned to you. The person giving the property is the lender, and the person to whom it is given is the borrower. For this video, please consider a debt as something to be used and replaced. If a neighbor's car runs out of fuel and you lend him some, it's reasonable to expect a return of at least the same level of fuel that he borrowed. You don't insist that he returns the same field since the idea was to use and replace. That's how monetary debts work as well. The best place to start examining the banker-customer relationship is from the interaction a customer has with an account, which is as a result of the initial basic banking contract. Now, CBN regards bank accounts as operational records held by the bank exclusive to the customer, even where the customer holds the account for other beneficiaries, like a client account. Let's get one thing straight. This exclusive access is for usage, and it does not imply that you own the account. To own something, you must have the full bundle of permanent and heritable rights to possess, use, transfer, and dispose that property. Since you do not manage the account, you can't sell it or gift it to another, you can't delete your account, then you are not the owner. You can only use your account and request for a closure of the account when you're done. Your instruction for closure of an account is not a right of disposal, but it puts a bar or sort of a stop to further entries being made on the account by way of transaction. The account will still exist for at least 5 years after closure or for whatever longer duration CBN or NFIU demands. By and large, you can't own, but you can use a bank account. That said, for efficient operations, basic bookkeeping practices dictate that the bank record transactions in a debit and credit ledger format in an account. Every deposit is made on the understanding that it is payable on demand. That means money deposited with the bank is not ready money since it is not kept for you in specie. Okay, here money in specie is keeping money in the same currency denomination and the exact notes and form in which it was handed over to the bank. In this age, it is hard to keep money in specie since the cash received is all mixed up in one vault for business, and since some inflows on an account will come in not as cash but as transfer of value for later cash settlements between banks. The only instance where a customer would have been the owner of monies paid into a bank is if deposits were kept in specie. If so, that would mean your bank account would be like a separate safe deposit box in a vault at the bank, to which only you have exclusive access to keep your money, documents, jewelries, whatever you want for safekeeping. In this case, the money kept in the box in specie is not kept as an abstract value using the debit and credit bookkeeping ledgers. For this, the bank will be compelled by law to hold the contents of the deposit box as a Bailee for you and you alone, with the intention that it is not to be used or applied for any other purpose until such a time when you say so. Aside this exclusive form of banking, the relationship that commences with opening a bank account, not a safe deposit box, is a use and replace debt payable on demand. So when you deposit money with the bank, a credit entry is made. As the name suggests, you become a creditor to the bank and the bank has a debt to pay you. Then, whenever you take out a portion of the money deposited and a debit entry is made, you are calling a portion of the debt owed to you by the bank. Typically, since a person cannot call in a debt that doesn't exist, a customer cannot make a withdrawal of funds that are not there unless that customer and his bank intend to reverse their roles, such that the customer becomes the debtor and the bank becomes the creditor. Whichever it is, the basic debit and credit relationship between a bank and the customer is a debt in contract. The bank owns not just the account, but the deposits you make into it. And since the debt is used and replaced upon demand, the bank bears all risk on the deposit along with the ownership they enjoy. So, you don't get to worry about theft, burglary, armed robbery, fire disasters, cash frauds, or even closure of a bank's branch. On the other hand, the bank can do with the money as it pleases, even put the money in jeopardy or carry out hazardous speculation without being answerable to the customer or without being guilty of breach of trust. It is a good thing for you as a customer to be in the position of a creditor on demand. And why is this a good thing? You needn't care anyway about the risk or the recklessness of the bank. All there is to do is demand for payment and the bank must pay. There is an implied promise to repay the debt to a customer upon demand, unless the parties had agreed that the money should not be repaid on demand. Failure to pay is simply a breach of contract, and better yet, if it involves a wrongfully dishonored check, then you can conveniently add defamation to your case. You can prove you suffered damage from the bank's failure to repay you, and the courts will rush to your aid. However, a customer cannot accuse the bank of conversion or detinue on the money withheld from payment, because conversion and detinue only applies to physical property, or what we refer to as chattels, which must be owned by the person making the case. So where does agency feature in banking contracts? Or even still, is the bank ever held as an agent of the customer? Yes, there are instances where the bank stands as an agent to the customer, and these instances include where the bank is acting as a collection agent for the customer. For collections, think of the bank as a conduit or pipe for receiving value on checks lodged or for payments made for the customer's benefit. Transfers and check lodgements are not as straight through as you imagine. You have multiple parties. On one hand, you have a sender and a paying bank. On the other hand, you have the receiving bank and the beneficiary, and in between them, you have the intermediaries. They come either as the central switch, the clearinghouse, or the settlement bank. For a very brief moment in this chain, until the money received is remitted, an agency applies only to the receiving bank, who is collecting inflow values from third parties. Upon lodgement, the bank resumes its role as a debtor again for the sums lodged into the beneficiary customer's account. At that brief point of agency, the bank has a duty to present bills for collection within reasonable time, the duty to hold the proceeds at the customer's disposal, the duty to give notice if the bill is dishonored, and the duty to give full account to the customer. Other fiduciary duties on the agent that arise in equity will also apply, such as disclosure of all material facts, avoidance of conflict of interest, or prohibition of secret profit, say in instances where the bank routes the money through another person's account before final lodgement. Anyway, with the adoption of technology, these collections are by and by becoming more instant and more straight through. Hence, the role of banks as an agent in this regard seems to be shrinking as banking becomes smarter. Nevertheless, the duty to exercise reasonable care and skill will always still remain. Okay, there is no outright trust in banking. Not confidence, but legal trust. The institution of a legal trust does not exist in banking. This is because you do not have beneficial ownership of the money you deposit. So the bank does not bear those steep duties that a legal trust imposes on a trustee, especially with regard to the duty to act in the sole interest of a customer. However, there is a special fiduciary duty of trust or confidence in negotiations when counseling or informing a customer of material facts relating to transactions. Fiduciary responsibilities require the bank to demonstrate utmost good faith and confidence with a high standard of care and skill when dealing with customers. This duty only arises if the banker knows or has reason to know that the customer is placing trust and confidence in the bank and is relying on the bank's expertise to make a decision. In this instance, the bank must advise the customer honestly based on all material facts within the bank's knowledge or as can be reasonably imputed on the bank. For a better understanding of this particular fiduciary duty on the bank in negotiations, please see our video on what you must never do regarding standard form contracts. In summary, under your basic banking contracts, the account is not your own. The deposit in it is not your own either, and the bank can use the money as it pleases, bearing the risk of whatever happens to your deposit. What you have is a right to call in a debt. Once your money is payable on demand, the bank's debt to you remains due and payable unless you subscribe to a product or service that makes the money either not due or not payable at the time you make a demand. The bank has an obligation to pay you once a written demand is made in form of a withdrawal request, and failure of the bank to pay leaves them open to litigation. You can claim damages for breach of contract, for negligence for not exercising reasonable care and skill, for defamation when your checks are wrongfully dishonored, for breach of fiduciary duties, and where possible, for interest that can be claimed as of right under any mercantile custom or in equity. This brings us to a close for this video. Here are some key references for your further reading. Some of the subjects are in the description below along with the timestamps. Please let us know in the comment box below or via our email if you need further clarification on any of the subjects in this video. And thank you for watching. For the next video in this series, we will review how your credit account balance is due and payable and what can affect repayment of money deposited as payable on demand. See you in the next video.